The outlook for housing and prices might still be gloomy in 2023, but for those of us needing to buy a home this year, there are still some ways to prepare. Let's take a look at how to make the process more affordable and secure. Joining us now, Yahoo Finance contributor Vera Gibbons. A lot of people looking at these house prices and wondering, oh, what can I do at this point?
Right. You know, Rochelle, that's the top challenge for 2023 is affordability. So you've got prices still elevated. You've also got mortgage rates significantly higher than they were a year ago. We're at about 7% now, which is almost double what we were at the start of 2022. So that continues to be challenging. But the good news is that inventory is up a little bit. Fewer buyers are actually out there hunting, so you might have a little less competition. Not to say that you're going to get a deal necessarily or a bargain. It's still a pretty challenging market, but it's not going to be as crazy nutty as it has been over the past couple of years. It's going to be more balanced, according to the experts I've spoken to. They say that's what we can expect. Not the frenzied, crazy pace, nothing at all like last year or the previous year, but a more balanced market. So that's good news.
So what tips do you have for people in this environment? How can they sort of edge out some of the competition and get a home?
Well, first things first, of course, you've got to, get your financial house in order. That means, wiping away any outstanding debt, boosting your credit score so that you can get the best possible rate on mortgages. Particularly important now since mortgage rates are so high. The better your credit score, the better mortgage rate you're actually going to get. Then, of course, you want to shop around to get pre-approved for that mortgage. And you do want to shop around. Don't just go to one lender. But once you can figure out what you can comfortably afford month to month, shop around and see what kind of rate you can get that is going to meet your budget. Once you've got the finances squared away, then you can hit the ground running. But you don't actually have to run. That's the good thing about the market in 2023. You can actually take your time to some degree. You can look around, check out the neighborhoods, know what the crime situation is in the neighborhoods. Research the school district because, as you very well know, home values tend to hold up better in a decent school district. Also, check out the commute. What is your commute to work going to be like? Are you going to have to commute? You've actually got a little bit of time on your side. So look at the whole picture and then also factor in additional financial costs. I think a lot of people overlook things like homeowners insurance, for example, in a market where I am in Florida. Those premiums have skyrocketed because of the hurricanes. So that's something you want to factor in as well. If you're mortgaging your purchase, you do have to get homeowners. But as I say, in a market like Florida or even a market like California, because of the wildfires, those premiums are extremely expensive. So you want to factor that in, as well as costs like the HOA fees, property taxes. I think a lot of people, especially first-time buyers, jump in feet first thinking, oh, they've got the down payment and they can figure out the monthly payments. But that's really just the start of home ownership. And then finally, I would say, make sure you're willing to make a long-term commitment because the transaction costs of moving in and out every couple of years is just not worth it. So make sure you're able to commit to 3 to 5 years. Make sure your job is secure. And if your job isn't secure, make sure you've got some extra money in the bank parked away so that you don't run into a financial pickle. So there's a lot of different moving parts to buying in 2023. But again, the good news is that it's not going to be as crazy, competitive, bidding war type of situation that we've seen over the past couple of years.
So still complex, but at least not as competitive as we've seen over the past year. Great stuff. Vera Gibbons there, Yahoo Finance contributor. Thank you so much.
Mortgage application demand jumping as mortgage rates drop. Application volume climbing 28% from the prior week. That's according to Mortgage Bankers Association Index. Meanwhile, refinance demand was up 34% last week, but that's still 80% below where it was just about a year ago. Tomorrow, we will get updated mortgage rate data from Fannie and Freddie. But last week, we did see the 30-year fixed mortgage rates fall to 6.33%, Dave.
It is remarkable to see rates continue to fall. And it doesn't, Shauna, look like they're going to go back up above 7, which is where we were when we peaked. Now, are we going anywhere near the 3.5 we were a year ago? No. But it is surprising to see people get off the sidelines at this number. Most of them are still locked in a sub-2, mid-3 mortgage rate. So it's surprising to see that thaw this market at all. I would not get too consumed by one weekly number like this. I still think what we're looking at is prices a single-digit drop this year. None of that panicky 20% peak to trough fall that some have predicted.
Yeah, exactly. And I think that also begs the question of what it's going to take to get some of those home buyers who are on the sidelines off the sidelines. Because when we even take a look, or some of the sellers off the sidelines as well, because taking a look at some of these inventory numbers, this is according to Redfin data. Now, active listings is about 21% higher than what it was about a year ago. But that's mostly because homes are now sitting on the market for longer. We haven't necessarily seen more homes come on the market. New home listings are actually off 22% year over year. So it's going to be interesting to see what it takes in order to really bring back some of the momentum in housing. But I think it's safe to say it's going to be months away from where we are today.
Well, we do have a number that could help in that capacity. For the first time in a year, home builder sentiment actually picked up. Yes, first time in a year. January saw an unexpected gain in single family sentiment, rising, albeit slightly, 4 points to 35. That's according to the National Association of Home Builders and Wells Fargo. Still, anything below 50 is considered negative, so we are still in that territory. The sentiment was more than double a year ago, registering 83 last January, so we're a long way from out of the woods. In a word, the year in real estate saw wealth destruction, given the rapid rise of interest rates. But 2023 should bring falling rates and that destruction replaced by disruption. Let's talk real estate with Hines Global Chief Investment Officer David Steinbach. He's with us now. Good to see you, sir. So you say disruption brings real estate opportunities. Play that out for us. And where exist those primary opportunities?
Great. Well, look, thanks for having me. So Hines is a $100 billion global investment manager. We focus on real estate. We're in about 30 countries around the world. I'm actually calling from you here in Davos today. So I would say that disruption is definitely a topic here as well. I think that investors right now are really seeing the change that's already happened, right? Interest rates kind of riding this wave of low interest rates, and the cap rate compression that comes with that is over, and now the hard work of asset management really begins, and that's really what's in front of most investors today. I think though the general mood that I'm feeling here in Davos though is that I think that people are pretty somber about the realities of the market. And really starting to focus much more on the beginning of a new cycle rather than the end of an old one.
Sure. And rates that, should we believe, begin to fall, are they optimistic about investment opportunities in real estate as we move forward?
Yeah, so I think that the way to think about the built environment is certainly one is that for an institutional investor, real estate is a longer term investment that we're making. So it's not something that we're flipping in and out of like equities or bond. And most business plans are lasting 5 to 10 years. And so in light of that, interest rates are certainly a driver of value, and they've had their impact this last year. I think that obviously if rates continue to move in this coming year, that'll also be a driver. But I think what I'm saying though, the focus is really on how to create the value at the real estate itself, how to drive rents, how to create something that is special and unique, something that is going to outperform within the context of a particular market. But where the rates are today, again, it does affect value. But I think most real estate investors are thinking longer term when they're underwriting a deal today. Give me
a sector and a region in terms of housing that you are optimistic about as we move forward.
Sure. Yeah. So Hines is involved in really all the major product types. We're in multifamily, we're in office, we're in logistics, retail. And certainly in the housing sector, I think particularly in apartments, which is what we focus on with our institutional and retail clients, it's really what is interesting about that asset class is the fact that rents mark to market every year. And that is different than the other major product types where investors are relying on a bit longer term leases. And the fact that mark to market every year means two things. One is you are going to see, as fundamentals have come down in many markets, particularly here in the United States, you will see returns come down as well. With that said, on the other side of recovery, it'll be the first to come back up because, again, you're marking to market at a much faster pace than the other product types. So look, broadly, I do think that demand around multifamily, while it has slowed, I do think that given this dynamic in the lease term, that it will be one of the first things that investors will be focused on the other side. And look, fundamentals in the United States, they are declining. So you have to focus on the fundamental real estate you're buying. And again, think longer term. I mean, you're buying something today, you're going to own it for 5 to 10 years. You want to make sure what you are going to buy today is something that will perform in that time frame.
Let's turn to office now, and one of the big question marks that lies ahead. Are you bullish or bearish, and what's been the impact of remote work, and do we know the true impact just yet?
Sure. So the way we are obviously investing is around the world, and I think this return from work question is a really interesting one, because when you zoom out and look at the world in total and look at how everyone has responded post-COVID, every country is not in the same place in terms of how much remote work that they're relying on. So Asia, for example, would be one end of the spectrum, and frankly, the West Coast of the United States would be the other end. And basically all the geographies are somewhere in between there, with Europe being somewhere in between as well. And so what that tells me is two things. One is it says that whatever you might be experiencing today in your market that you're seeing every day is not necessarily the felt experience of those around the world. So as an investor, you have to think globally in that perspective. But the second thing is that what we're seeing is that there is a steady trend back. I mean, the chart is up and to the right. And even markets that, like in Asia, where it was nowhere near like what it was in the West Coast of the United States, for example, even that is on the right road, if you will. With that said, what we're seeing as well is that particularly here in the United States, it statistically seems to us that 90% of the tenants are chasing about 10% of the space. And so if you own projects today in that 10%, what we're seeing in our portfolio is they're actually performing really well. I mean, we're seeing rents within that narrow band, which is the highest quality, obviously, some of the highest rents that we've done. We've got projects in New York, and it is surprising when you see the headlines and see the data. But what's interesting, though, is despite that dynamic, the 90 chasing the 10, capital markets seem to be painting a much broader brush across the product type and really not seeing through that yet. I think that'll be another thing that we're going to see evolve in the next coming quarters, where investors are going to be looking a bit more carefully at what exactly is happening in fundamentals and look at the data as they do their due diligence. I think that they'll take a turning view.
All right, check back with us in a few months. David Steinbach, Hines Global, joining us from Davos. Appreciate it, sir.
We're here with Jason Oppenheim, owner of the Oppenheim Group and star of Selling Sunset on Netflix. But before we get to Selling Sunset, we're going to talk about selling real estate. So what I've been hearing is a lot of doom and gloom in the market. Give us a reality check. What are you seeing out there?
I'm not the doom and gloom type. I think we probably saw the bottom of the market at the end of 2022. Probably saw the height of interest rates at the end of 2022. So I'm generally optimistic, but I don't want to pretend that means the real estate market's going to be, on the ascend. I'd say we're probably in for like some type of homeostasis, like just not much growth, probably not much, downward either.
Do you think, you said we've kind of reached what might be a homeostasis too. For you in your business day to day, what does that look like?
Well, we're going to have a rough couple of years, I think, because volume is down. So when I look at real estate, I guess there's two things: prices, which is really what the people care about, and then there's volume, which is what real estate agents care about. In terms of prices, I think there's going to be some stability, which is probably healthy for the market. We can't have that kind of, we don't want the spikes and downs. So I think we're going to see a relatively healthy market over the next few years in real estate as it relates to prices. And we've got a lot of people that own homes that have very low interest rate loans, and they're not going to be selling. So we're going to have low supply generally, probably low-ish demand.
What are kind of some of the concerns you're seeing that transcend income brackets?
Interest rates largely transcend income brackets, although I think affect more the lower income brackets. That is really the hardest. I mean, people talk about affordability of homes. Really, it's the down payment. You got to come up with a down payment. That's always been difficult. But now not only do you have the down payment, now you got to pay a 5 or 6% interest rate, even on a 5 or 10 year fixed. I think that will come down in the next couple of years. So I don't think it's a big deal if someone goes in and buys a house and has a 5% interest rate. And I don't recommend people getting 30 years anymore. You should probably get a 5 year. Probably you're going to be able to refinance in a few years. And buying's always better than renting if you can hold the asset and you can ride the ups and downs, and you can take advantage of the appreciation over a decade or 2 decades or hopefully 3 decades. Then I think buying really always makes sense. Doesn't make sense always in the short term. You've got transaction costs, and you're limited in your mobility when you're an owner. You're dealing with a lot of hassles when it comes to the roof leak. It's not the landlord's fault anymore. Now it's your problem. So if you're looking to own and just for a couple of years, probably consider renting.
And here in LA, where, when people are buying now in the situations where they are, where are you seeing the money come from? What professions generally are they in? Are there any kind of trends you've seen in the cases where people are bucking the overall slowdown?
There's a lot of wealth out there still. So, I'm not concerned about the luxury market. Honestly, I'm not even really that concerned about any of the markets. There was an open house yesterday for a $1.6 million house up in the hills. 300 people came by the open house in this environment with these interest rates. So there's still demand out there. I think it's good. 2 years ago, even a year ago, everything was selling. I don't think that's healthy. I mean, crap was selling. And I think that developers and people should be building quality product. And I think people should be more discerning and not being, a year ago, literally you'd get 10 offers on a crappy house with no yard. Now, I think, again, it's back to a healthier market.
My sense that what I'm kind of getting from you is that despite the doom and gloom narrative out there, there is right sizing happening, and there's also a lot of reshuffling going on from where you sit.
Yeah, I mean, I think COVID changed a lot in our psyches. The at-home work, people focusing more on the house, more willing to move out of the city. You look at some of these states that were laughed at a few years ago, and now they are, where everyone's moving. I mean, Austin, Texas, and Miami, and Las Vegas, and like Scottsdale, Arizona. I mean, these were not places people took as seriously as they do now. That trend is not going to. Obviously, we're going to see some people coming back into the big cities. I think New York and Los Angeles will be fine, and I think those cities will have some difficulty the next couple of years. But they're on the map, and now there's competition. You don't have to live in LA. You don't have to live in San Francisco. You don't have to live in New York. You can now live in these other cities, and I think that's going to be a draw away from some of the big cities if we can't get a handle on some of these macro issues that we're dealing with. I hope that we can. Like I said, I'm generally an optimist. I think that people that make money in real estate and pretty much anywhere have to be optimistic.
And last thing I wanted to ask you, Jason, in the middle of all this, right, Selling Sunset blew up, right? I'm sure you haven't been asked about it ever.
Yeah. I'm just surprised it took this long.
It took this long. Yeah, what can I do? What can I say? I wanted to surprise you. But my question is actually not about Selling Sunset itself, but why you think it was so popular.
I've thought about that, and I think it's because it checks a lot of different boxes for a lot of different people. And I realize that because of the people that come up to me. It's such a wide swath and a different demographics all the time.
How wide are we talking here?
I mean, you just wouldn't believe. Well, to every country I go to, I've probably been to a dozen countries in the last couple of years. And it's just every age group, every ethnicity, it could be from like a football player to like a 7-year-old girl to like a 85-year-old man. I mean, it's so weird. So I think, again, there's different check boxes. Real estate is just fun to watch. That's my favorite thing about the show. And I think that's probably what ties in so many different demographics of people. Then I think the beautiful women and just the beautiful women. And the fashion, I think a ton of people love the women's fashion, and I'm trying to do what I can now. Los Angeles, Sunset Strip, all the kind of restaurants and nightclubs and lounges and cafes and that kind of thing. So and then of course there's the real world drama among, successful, beautiful women that are really striving to, take control of their careers. So there is a lot for everybody.
Thank you so much for joining us, Jason.
Yeah, my pleasure. Thank you for everything.
Well, it is a new year, and you may be interested in a new house. Mortgage rates have cooled demand for homes. The number of homes sold is down 37% from a year ago. That's according to Redfin data. We want to take a deep dive into housing markets across the country and take a look at Denver, at Indianapolis, and at Charlotte. We have Kathy Casey, Caldwell Banker, residential brokerage realtor in Denver, Colorado. Dan O'Brien, realtor at True Blood Real Estate covering Indianapolis. And Sir Ashley Harrison, real estate broker at the Harrison Group with Fathom Realty in Charlotte, North Carolina. It's great to have the three of you here. We want to jump right in and get to what you're seeing in your respective regions. We're going to go around the horn pretty quickly. Kathy, let me start with you. What are the trends? What are you seeing in Denver?
So Denver, our market is cyclical. So typically the spring market starts in January. So we are already starting to see signs of the spring market showing that it may be a heated market. In December, the market was kind of slow and buyers really were taking their time. They were able to really pick and choose what they want, and they were asking for seller concessions and the contingencies that they haven't had the luxury to be able to ask for in the last couple of years.
Dan, what about you? What are you seeing in Indianapolis?
Yeah, things have certainly slowed down since the craziness of the COVID market, right? So things are lasting a little bit longer on the market. Days on market is up, but the median sales price is still up 9% or so year over year. But buyer demand has certainly slowed down with those rising interest rates. And so it's one of those things where we've been seeing new listings coming on the market, but they just take a little bit longer. And the question, like you were talking about, is do sellers, reduce the price? Do they play the waiting game? So we anticipate still a busy year this year. And, time will tell to see what happens.
Sir, how does this compare to what you're seeing in Charlotte?
Pretty similar. We're seeing more inventory, but less new listings, and buyer demand has fallen off, and we are getting a lot more seller concessions, but pricing has remained very sticky.
So I want to stay with you because we mentioned the top 10 markets all basically in your region. North Carolina is on fire. What do you make of it? What makes North Carolina such a perfect storm for real estate markets right now?
Well, affordability. You named it earlier in the segment. Affordability is the driving point, and a lot of industry is coming to the Carolinas and North Carolina in particular. Just this past year, North Carolina was ranked #1 by Wall Street Journal as the #1 place to do business. So I think that's the main driving point.
Kathy, when you take a look at Denver's housing market, it's incredible taking a look at the prices because they have certainly exploded. They're up 30% when you compare it to the levels that we saw back in March 2020. What is that doing for demand? And I guess, where do you see prices headed? How long until they really come back down?
So, our prices luckily have been pretty much holding steady. I mean, we lost about 5% since the interest rates started to have that uptick. But the prices are still holding steady because inventory is still low. So, for buyers, this is a great time because now, the line's not as long for you to get into a house. So you can get into a house much easier than you could months ago. And, we have a saying in our industry that is, date the interest rate, marry the house. So go out, find a house that you like and you love, and then, wait till, you can get that interest rate at, that's more for 30 years, that's going to be more appealing to you.
The inventory story has been bleak across the country at best. However, not necessarily the case in Indy. What are you seeing there, Dan?
Yeah, so year over year, we're up 75% from this time last year. However, to put that in perspective, we just now broke, the number where it was pre-COVID. So before March 2020, when the market went crazy, we're just now getting back to then. And at that time, we were talking about low inventory anyways. So, a lot of people talk about the last 6 to 12 months, but putting in a big picture view, we are still, low in inventory. It is technically a seller's market, but things are looking pretty good leading into the year.
So you're right in the middle of one of the hottest housing markets, if not the hottest housing market. What are some of the tips for people who are interested in or maybe looking to buy in Charlotte?
Yes, I say right now, if you have been on the margins and could not get your offer accepted in the past 2 years, now is the time to move. Although interest rates are a little higher, you're not competing with as many people. So the sellers weren't considering your offer. Now they will consider it, and they may offer seller concessions.
Concessions have been a theme across the country, just like low inventory. Redfin says 42% of home sales in the fourth quarter gave concessions. Kathy, what type of concessions are sellers forced to offer right now?
Right now, sellers are offering to help with the interest rate increase. So they are offering 2-1 buy downs. And if you don't know what that is, basically what that means is for the first 2 years, your interest rate would be lower than it would lower at the market rate right now, the current market rate. So they're offering that. Typically, that costs somewhere between $10,000 to $20,000, depending on how deep they want to cut the interest rate. And that's what's really helping buyers really get into the houses that they want to, because affordability is key here in Colorado. Just to give you some perspective, our home prices have doubled in the last 10 years. And so, wages just can't keep up with that. So anything to help the buyers get into the house is what sellers are doing right now.
Dan, what about concessions in Indy? Is that something that's becoming more and more popular? And what are people offering?
Yeah, same thing here. People are getting creative with the mortgage lending. Different banks are offering different types of mortgage products to help with that increased mortgage rate. Also, sellers, again, similar, are offering a credit for a 2-1 buy down, or just in general to buy down the interest rate to make that more affordable for a buyer. Now we actually have buyers that are being protected by contingencies like inspection and appraisal, where a lot of times those were out the window during the peak craziness of the COVID market. And so it's not getting too crazy or anything like that, but sellers are absolutely having to negotiate. Gone are the days of, hey, my next door neighbor just sold last year for $100,000 over list price. Things are still happening where there are some hot areas that are demanding multiple offers in a matter of days, but sellers are having to actually come back and come to reality with negotiating like they used to.
Sir, what are you seeing in terms of concessions, and what in this market, as we're coming out of COVID, really with the new dynamic, what's the number one thing you recommend that helps move a house today?
Yeah, thank you for that. The concessions I see are paying for closing costs and to buy down the interest rate right now. And it really depends on the loan the buyer's getting and how much concessions they can ask and seek from the seller. The main thing I think buyers can do moving forward is to, one, study the market. Know exactly what's happening. Don't assume just because the market is totally different than last year. Study the market, but also surround yourself with trusted professionals. That's the biggest thing.
Kathy, investor activity has been a huge story when it comes to housing. A lot of the pricing being driven by the jump that we certainly have seen in investor activity. How much of that are you seeing in Denver?
Well, I can tell you, I probably get a call, at least 3 or 4 calls a day from investors wanting to know if I have anything off market that they can fix up and flip, because it's really that tight for investors right now to find anything where they're going to be able, and pricing is kind of a guess, and not only say a guessing game, but you have to be really strategic. You have to really know how to price things. So investors, want to make sure they're going to be able to get that return on investment. So if they can't get it for a really just awesome price, then, it's really not worth it to them, because the uncertainty of the market has got them a little wavering in their decisions for investing into the market right now.
Dan, what's the investment activity in the Circle City?
Yeah, it's been very heavy. It's jumped from, I think in 2020, it was about 8 or 11% of the purchases were to investors, and 2022 is over 25%. So 1 in 4 houses is being sold to an investor right now. And you have some of these billion-dollar companies, Tricon, BlackRock, all these people with billions of dollars, and they can park it into a hard asset like real estate. And it's been really difficult, especially for first-time homebuyers, to compete with these all cash, no inspection, no appraisal offers. And it's also made it difficult for the rental market as well. Rent is up, 20% year over year. And so it's been a really difficult thing to combat. How do you, can you create laws to prohibit some of these big billion-dollar companies from doing it, but not impede on individual rights for, people that want to own investment properties as financial planning. But investment has definitely been a difficult topic here recently.
It's certainly amazing to really take a look at the uptick in activity. We want to go around the horn once again. Quickly, just get your thoughts. Sir, first to you, your top prediction for the housing market this year.
I think interest rates will come down to the low fives, but it'll be harder to get a loan. And it's going to, at least in my area of the country, prices will level off but tend upward.
Kathy?
So I predict that we have about 90 days of this interest rates will still be kind of maybe even on the uptick. And then I think that they will start to come down as well. And I believe that our prices will continue to hold. And so if you're looking to buy, don't wait because you want to get out there before the rest of the market jumps back in. That's been on the sidelines.
Dan, you got the final word. Your top prediction for 2023.
Yeah, very similar. So I think mortgage rates will level off, come back down towards the end of the year. Buyer activity will then pick back up. I don't anticipate any kind of decrease in value, anything like that, maybe plateau, but normalize back to a normal level.
All right, Dan O'Brien, Kathy Casey, Sir Ashley Harrison. Nice to have the latest from Indianapolis, North Carolina, my hometown of Denver. Thanks to all of you.
What you are looking at is at all the top real estate markets to watch. This is according to the National Association of Realtors. And Dave, weigh in here because my first take, obviously a lot in the South, but 3 here in the Southeast.
Yeah, what really stands out is what is not covered on this map. Basically anything west of the Mississippi, the entire West Coast is left out. Also New York, Boston, Philadelphia in the Northeast. And why is everything converging in this basic region? No matter what list you see, it's based on 3 things: affordability, jobs, and of course, quality of life. And that comes down to weather, that comes down to outdoor things to do, and that comes down to even the commute that you're not having up in the Northeast and in California. And that's why all the top 10s are centered right there.
Yeah.
Let's talk more about mortgage rates with Melissa Cohn, William Ravis Mortgage Regional Vice President. Melissa, nice to see you. Thanks for coming on. Where do you see these rates flattening out, and what do you think will be enough to really thaw what has become a frozen housing market?
Well, I think the good news is that we are seeing that inflation is moderating and cooling, as we saw this morning with the CPI number. And we're seeing other signs of weakening in the economy, and that means that bond yields are coming down. The 10-year Treasury was at a 3.45 the last time I looked at it. And, mortgage rates have declined by almost a full percentage point since they peaked in November. And I think that we can expect mortgage rates to go down another quarter or even as much as 0.5% over the course of the next month. It's the beginning of 2023. Everyone is back to zero in terms of meeting their goals, and everyone has to bring loans in the door. And I think banks are going to sharpen their pencils. They're going to tighten up their margins and do whatever they can to bring volume in the door, and lower rates will bring, more real estate transactions. We also saw another figure that refinancing was at the highest level it's been in a while as rates have declined.
I do want to follow up on that refinancing in a second, but what would you tell those buyers who have been sitting on the sidelines waiting for rates to return to that mid to low 3 level in order to get back in on this market?
Well, I think people can't expect that we're going to go back to a 3% 30-year fixed rate. That happened because of COVID and the pandemic, and we don't want to find ourselves in that position again. If we can get interest rates to go back to where they were pre-COVID, call that anywhere from 3.75% to 4.5%, that would be a home run. But buyers need to, my favorite expression is you marry the house and you date the rate. So they want to find a way to get into the house today. You'll generally find that when mortgage rates are higher, that real estate prices tend to be a little bit softer. And when interest rates do come down, and they will come down more than just the 1/4 or 0.5% over the course of the next year and a half, real estate prices will start to go back up again, and there'll be more competition for the homes on the market.
Melissa, for the first-time home buyer, I think applying for a mortgage sounds very daunting. A lot of people don't know where to turn. What is your advice to that first-time home buyer in terms of what they need to know when doing that?
Well, I think that they need to, first of all, be willing to take into consideration looking at an adjustable rate mortgage. Looking at a 5 or a 7 year adjustable, that means that rate's fixed for the first 5 or 7 years, and it's the same thing as a fixed rate for that initial period, but the rate is going to be lower and it'll make the home that much more affordable. They also need to make sure that they've done everything to keep their credit scores as high as possible, because in many banks price rates based on someone's credit score, and to make sure that they have sufficient money for the down payment and for reserves. We find a lot of first-time home buyers getting stuck because they maybe have enough money for the down payment, but haven't taken into consideration all of the closing costs and what you need to have for reserves. And the last thing is, in terms of looking at your credit, make sure you have enough credit. So many people today, especially younger people, tend to live off of a debit card or perhaps just one credit card. And many of the banks with better rates are going to want to see someone having 3 to 4 different active trade lines on their credit history.
Those ARMs adjustable rates certainly come with the downside. What's your word of warning to people that do go that route?
Well, I think the risk that you have with an adjustable rate is that either that you've had some sort of negative work issue where you no longer qualify to refinance, or for whatever reason, if the value of that home drops, you may not have the equity to refinance. But if you're locking in for, I say a 7-year adjustable is a safe period of time, you're going to mitigate those risks. Really the goal is what can you do to get into a house today, and then be prepared to refinance when fixed rates get down to a more acceptable level, if you think you're going to be in that home long term. Most first-time home buyers are not in their home for 10 or 15 years. The average, tenure of that home is probably closer to 7 or 8 years.
Well, so going back to that advice here for the first-time home buyer, you mentioned the down payment, how critical that is. People need to think about not only what they're putting down, but also budget for what they will be paying on a monthly basis going forward. 20%, that often is the number thrown out. Is that the best number, aside from obviously an all-cash offer, for a person that is buying a house to put down?
Well, the benefit of putting 20% down is that you don't have to have the mortgage insurance. So that saves you on a monthly payment. If you are a first-time home buyer for a conventional loan, which now goes up to $726,000, except in the high-cost areas where it's even higher, over $1 million, you can put down as little as 3%. But you obviously, the less you put down, the higher the payment and the higher the mortgage insurance that you're going to have to pay on top of the mortgage payment, the insurance, the taxes.
Melissa Cohn, William Ravis, Mortgage Regional Vice President. Thanks so much for joining us here this afternoon. For the last hour, we have been looking at all aspects of the housing market, taking a look at the various regions, what is driving the housing market. And Dave, despite the challenges that remain in the near term, one overall theme I really took from today's special is the fact that so many people are upbeat about what we would likely see at the end of 2023 going into 2024. And the advice that we got from some of the realtors at the start of the show, especially in Denver, saying that don't necessarily wait until the housing price drops. Right now, she's not expecting that to really happen anytime soon. Her advice to buyers was get in now. You can always refinance. She said date the rate, marry the house, saying you could always refinance when rates drop. So that was her advice today. I love that.
I think what my big takeaway is here, the pandemic has, changed everything for everyone, but it really has remodeled the real estate market, and it's changed the entire map. It's changed where we want to live and how we want to live, and primarily it's put quality of life back where it ought to be on top of that list. And that's why we see maps just like this. But we see it across the country. Boise, Idaho. We see it in Phoenix, Arizona. We see it in Nashville, Tennessee. People are moving to places that their quality of life is now higher, and they're also making the same renovations that make their quality of life. And I too think the dire predictions will not come true. Low single-digit home declines in 23. This market's resilient. It's going to be fine.
Yeah, affordability really the key driver here in the housing market going forward.
All right, one thing we know for certain is buying a house this year may be a lot harder than buying in 2022. Yahoo Finance's Allie Garfinkel spoke to some hopeful buyers and real estate experts about what it's like navigating today's market. What did we learn?
Hi, Dave. To put it simply, it's rough out there. Here in Southern California, I'm standing in front of this sign that's a for sale sign, right? Part of the problem is there aren't enough signs like this. There's, to put it simply, a massive inventory problem. So what's happening is that it's making things even more difficult for home buyers. Take a look.
We've been looking for a home for, I would say, 2 years, more or less, give or take.
Danielle Cohen and her husband David Jarvie from Los Angeles are facing the same dilemma as home buyers across the country.
It just came to a grinding halt when interest rates went crazy, and now we're just not finding a lot on the market. So
I think a lot of people right now are afraid to list their house, so if they don't have to, they won't.
The average 30-year fixed loan is hovering around 6.5%. But as the Federal Reserve pulls back on the pace of its aggressive rate hikes, the Mortgage Bankers Association expects the 30-year fixed to drop to 5.2% by the end of this year. That's well below the historical average of 7.75%. Ed Fitz is a real estate agent and partner at the agency in Los Angeles.
Buyers are really holding off at the moment for a variety of reasons, including the new interest rates that's changed things dramatically since last spring. Nobody quite knows where the market is going next, either in Los Angeles or California or even nationally.
Also freezing the market, sellers are reluctant to drop their prices. In real estate, the asking price is often as much about psychology as it is about reality. Fitz has gathered data on this through an app he launched called Domicile Game of Homes, sort of like The Price is Right for real estate.
People who are not actively in the market, who are just guessing the prices, what's the asking price, what's the ultimate selling price, are guessing higher than the house actually sells. The mind of the average consumer hasn't caught up to the realities of the market right now.
But sellers are being forced to cut prices. Realtor.com estimates 1 in 5 sellers nationwide are lowering their asking price. The states with the biggest cuts, the western part of the country. Arizona, Nevada, and Utah topping the list. Realtor.com predicts the 2023 housing market could become a nobody's market, not friendly to buyers nor to sellers.
Every time she's around, the energy changes.
We caught up with Jason Oppenheim, star of the hit Netflix series Selling Sunset.
I think we probably saw the bottom of the market at the end of 2022. Probably saw the height of interest rates at the end of 2022. So I'm generally optimistic, but I don't want to pretend that means the real estate market's going to be, on the ascend.
For Danielle and David, they're hopeful they'll find a great home soon.
Yeah, it's just waiting.
But the higher interest rates definitely affect buying power, right?
Yeah.
So the reality is this: while it's incredibly difficult to find a home right now, it's not just a matter of finding your dream home. It's a matter of completing the process altogether. Back to you in the studio.
Certainly isn't as tough in this environment. Ali Garfinkel, thanks so much.
All right, thank you, Shauna. The combination of hot inflation and rising mortgage rates have really frozen the real estate market on both ends. One way to heat things back up, well, sellers are looking to give concessions away. Let's talk about this phenomenon with Redfin Deputy Chief Economist Taylor Marr as part of our real estate report brought to you by Intuit TurboTax. It's good to see you, Taylor. So let's talk about these concessions. First, historically speaking, how significant are these concessions and what types of things are sellers giving away to buyers?
Yeah, thanks for having me on. I really appreciate being here. So what we've seen is a huge increase in concessions given to buyers in order to close the deal. Sellers are having a really tough time out there. What we see in Redfin data is that 42% of recent offers had a concession where the seller gave money back to the buyer in some form. And that's up from about 30% or less historically. So it is a record high, and we're seeing this really increase. Concessions can amount to $5,000 or $10,000 on average to basically go to fix a roof or pay down a mortgage rate and make it more affordable for the buyer to have that mortgage.
Are there particular markets where you're seeing this more so, and where are they?
Yeah, certainly. So the markets that are cooling down the most in reaction to higher interest rates and inflation and the weaker economy, those are all out on the West Coast. We see in the news a lot of tech layoffs. It's impacting places like Seattle, San Francisco, Phoenix, San Diego, Vegas. Those are all markets that have seen a big increase in these concessions. And overall, they're cooling down fast. So these are ways that sellers are trying to now have to lower their price too much.
Taylor, why are we seeing the opposite go into effect? Cities where we are certainly not seeing this, according to your data: Austin, Philly, New York City, and Chicago. Why do you think that is?
It's a great question. Concessions are more common when the market's cooling rapidly and ones that are more sensitive. So where we see prices falling the fastest. So these are places, Chicago, New York, Philly. These are also places that have been a bit more resilient. We haven't seen the market cool down as rapidly. They've been more stable. Austin's a weird exception, and I'm not exactly sure why we're not seeing more concessions. I think one reason might be because sellers are actually aggressively cutting their price rather than giving it back in the form of concessions. And it had a big boom in equity and real estate prices. So sellers might be just a little bit more willing to cut their price aggressively in Austin.
I've heard of some concessions being made where they are waiving inspection, which this real estate agent urges you not ever to do, no matter how desperate you are. So the question is, are these concessions enough to kind of thaw this frozen market? And that comes down to mortgage rates. What point do you think mortgage rates will get some action going again, and when do you see them leveling out?
That's an excellent question. Mortgage rates have been the key driver here in both cooling the market and, what will be the key factor to bring buyers back in. I think this Redfin data about sellers' concessions actually points to some really good news that buyers are able to get a better deal than might be realized when you first just look at the data of what they could afford. They're getting significant points paid onto their mortgage to make it more affordable. And what is likely to happen is we expect in 2023 that rates will continue to decline. In fact, after Friday's jobs report, we saw a big drop in the bond market affecting mortgage rates. And so already we think that's going to bring some buyers back, and they might be encouraged to know that there's a lot of homes that are dropping their price out there. They might also be able to get some concession. Now, I did mention these amounts are relatively small, about $5,000 on average, but that could be more advantageous to a buyer than a $5,000 price cut. So buyers are a bit more willing to negotiate in a seller's concession than they are to accept a lower sale price or get a bargain that way. And so it might actually be worth more both to the buyer and the seller that way. And at the same time, as the market starts to recover a little bit when rates fall, we'll start to see this moderate out too.
And speaking of home prices, Taylor, some have had some very dire predictions about the year ahead, talking about a 20% peak to trough. How significantly do you think the drop will be nationally in home prices in 23?
So our outlook for 2023 is that home prices will fall about 4% relative to the previous year. That will certainly be sharper in some metros. In Seattle, San Francisco, home values have already fallen more than 10%. And there have been some segments of the market where values have fallen 20 or 25%. So there's definitely weakness out there reacting to the market conditions. But overall, nationally, things still aren't going to be that dire compared to 2008. So our outlook is that even as prices decline, there will still be some affordability challenges for buyers out there. And, we'll be in a tough market for at least the first half of the year.
All right, Taylor Marr, great to have you, Redfin Deputy Chief Economist. The luxury home market now, according to the Wall Street Journal, 7 homes are worth $100 million or more closed last year. They were sold compared to 8 the year before. That, of course, though, is the wealthy, uber wealthy, high-end part of the market, because the luxury home market is not impervious to the changing economic landscape. Let's talk about what to expect in this space going forward. For that, we want to bring in Philip White. He's Sotheby's International Realty President and CEO. Philip, it's great to have you here. Let's talk about what you are seeing, because you're out with a new outlook in terms of what we could expect in 2023. We certainly did see a drop in 2022. Overall, looking at the real estate market, what are you expecting to see this year?
Well, thanks for having me. It's really great to be on the show. So, 2022 was somewhat of a tale of two markets. The first half of the year was strong. It tailed off in the second half. Of course, we're coming off of two incredible years, 2020 and 2021. 21 was a historic year. So, it's not unusual to, consider the fact that the market will kind of stabilize, which it did in 22. 23 remains to be seen. The forecasts really honestly, they're all over the place, whether it's Fannie Mae, the National Association of Realtors, Goldman Sachs, they all have different projections for 23. So it's really hard to really gauge it. I think, the concern that I have and that my agents have is really inventory. Inventory levels are historically very, very low. In some of the most desirable markets, there's only a 1 month or maybe 2 month supply of inventory. That's not expected to change too much. Part of it is that many people locked in very low interest rates during the last low interest rate environment we've been in. So they hesitate to let that go and buy another property. So that's kind of a two-edged sword that we're dealing with. But at the same time, I feel good about 23. I think we're going into it, in a strong way. I think what we're seeing also is that there's a divide between the buyer and the seller. The seller is really wants the multiple bid activity in 2020 and 2021. And the buyer is, looking at the volatility in the stock market and, those kind of headwinds. And that's where we are right now.
Let's talk about the rates. 6.48 on the average 30-year fixed, down from 7.08, but still more than double, to your point, what they were a year ago. How much is the luxury market impacted by the rates we have today?
Well, Dave, the interest rates, affect everything, obviously. For the high-end buyer, the impact is more seen, from a stock market point of view, with these high interest rates, as we all know, have impacted, certainly some of the high tech companies and have caused some portfolio declines for some of the ultra, high end investors. So, I think that's, when their portfolio gets hit, I think that's more impactful than the interest rates, because the high end buyer that we deal with is certainly much more capable of buying with cash. And we are seeing that. We're definitely seeing it in New York City. But we're seeing it in other markets as well. So they have that flexibility. They have a portfolio as well. So, they can sometimes borrow money against their assets, at lower rates as well.
Yeah. And Philip, the activity that you're seeing, the people that are buying, you mentioned New York City being one of those places that's still seeing some demand. Where else are people buying right now?
Well, they're still buying in Florida with, no state income taxes, just and the climate. And there's still affordability. There's affordable properties in Florida. Not everywhere, but in certainly many parts of Florida there are. So Colorado is still very strong. And I talked to our big company out there this morning, and they had a strong 22. I feel good about 23 as well. So Texas is still strong. So they're, the resort markets are still, strong. Some of them have not had as good a year as 21 for sure, but I think they've been holding up pretty well, even in light of the fact in some markets, prices, if you take Jackson Hole, Wyoming, prices have gone up in some cases 50 to 70% just during this, span of time.
And certainly have seen a huge price spike in some of those hot spots that you were just talking about. Philip White, Sotheby's International Realty President and CEO. Thanks so much.
Fed Chair Jerome Powell saying inflation in the housing market could start to cool by the middle of 2023. But will another 50-point hike further punish the housing sector? Joining us now is Zillow senior economist Jeff Tucker. Jeff, good to see you. How will today's decision by the Fed impact the housing sector that the Fed chair said, quote, had weakened significantly?
Yeah, today's announcement was not a surprise in terms of the actual 50 basis point hike. So I think that news of slightly taking his foot off the brakes had been priced in for mortgages and 10-year treasuries already. So it still seems like a small step in the right direction. We've seen that 10-year treasury working its way down from over 4% to 3.5%. And critically for housing, that has brought the mortgage rate down on a 30-year mortgage from over 7% back down to about 6 1/3. That's really major progress in terms of improving affordability for home buyers. And it's a long road for us to get back from this high inflation, high rate environment to a more slow and steady, low inflation, less costly environment. And we are making progress in that direction at this moment.
Jeff, you mentioned the progress that we're making, the drop in mortgage rates. Do you expect that decline to continue? And where do you think rates are headed then, if in fact we do see that decline continue?
I think that is the base case scenario right now. We're seeing a lot of, goods inflation kind of turning the corner. And we have a lot of reason to expect shelter inflation also to turn the corner in the new year. The Zillow Rent Index year-over-year growth peaked back in February. That takes time to flow through to the CPI rent index. So we expect sometime in the first or second quarter to actually see that begin to decelerate on a year-over-year basis. That's the single biggest component in services in the CPI. So putting that all together, I think the base case has to be that inflation kind of continues on this trajectory downward. So what does that do to mortgages? I think that does bring us back into the 5 to 6% range over the course of 2023. The more optimistic scenario is that we make a lot of progress toward the lower end of that range. The less optimistic scenario is that we end up stalling in the upper 5 point something percent range for mortgages.
Yeah, it really is hard to imagine rates getting much below 5. In terms of housing prices, what's your prediction for 23?
Yeah, our forecast right now, looking a year ahead, is for prices to fall by maybe 0.5 to 1 percentage point from now 12 months ahead. Either way, it's approximately flat. I know there are more bearish forecasts out there of more significant price declines. I think the number one factor in our model stopping us from that prediction is the low inventory. The inventory has not built up in a big way. A lot of sellers are just staying put in their homes. So it actually means out there in the market, you don't see a glut of homes for sale. That has kind of helped keep a lid on, some of those processes where prices actually begin to fall rapidly. There's definitely local color to this, of course, where West Coast markets and some of the inland West, like Phoenix and Las Vegas, they've already fallen maybe close to 10% from a peak back in about May or June. And I think they still have a little bit of room to come down. But at a national level, we just don't see this kind of inventory pressure of forced sellers or really motivated sellers. If anything, sellers are motivated, kind of stay put, hunker down, and stay warm by their 3% mortgage that they locked in back in 2021.
Jeff, what does all this mean then for the rental market? Because prices still substantially higher year over year, I guess on a month over month basis. You're starting, the data that Zillow put together, starting to see some improvement. So what does that mean in terms of rental prices, and how long until we see that reflected in the CPI data?
Yeah, we have seen asking rents actually begin to decline month over month in the last, basically this winter, even beyond the normal seasonal trend. So it looks like there's a bit of mean reversion of where that rent growth is cooling down really sharply. That is great news for renters. It's great news for the inflation measures, but it's really at least a 12-month lag from that slowdown in our asking rent index, filtering through to CPI for rent and owner's equivalent rent. It's hard to say, but I think maybe the best case scenario is that February could turn out to be the peak for year over year CPI rent growth. That would just be 12 months after our rent index peaked. There could be a bit of a lag. Maybe it's sometime in the spring. But we do know this is already bringing relief to renters, either getting renewal letters or going out there considering a new apartment to move into this winter.
Yeah, interesting really to see where they're falling the fastest. New York and Seattle among the top 5, not where you typically expect it. Speaking of regions, the Midwest appears to be the best place for first-time home buyers, according to Zillow data. Why so?
It's all about affordability. Affordability has been holding back the housing market, especially holding back home sales volume all around the country. That 1-2 punch of price appreciation and higher mortgage rates means that places like Seattle, New York, Miami, that mortgage is just out of reach for a large swath of home buyers at the moment. So we looked around the country, and where is the last kind of regional bastion of affordability? It's the Midwest. These are places where middle class families' income is still enough to qualify to buy a nice family-sized home. Nobody likes paying higher interest, even in the Midwest, but there's a lot more folks who can qualify to buy a home there, and where it's still looking like they're just in a good position to buy in those markets. I thought it was striking too that those were some of the same markets you just highlighted where rent is now growing the fastest. These are the markets where young folks setting out looking for a place of their own, whether renting or buying, they're finding more opportunity and kind of in the heartland, in the Midwest and the Great Lakes regions. So in terms of housing market activity, that's where we expect it to be the busiest in the year ahead.
Jeff, what about the trends of buying with family and friends? That's something that stuck out to me. A lot of us questioned it, whether or not that's a smart financial idea. I don't want you to weigh in on that, but that momentum really, I think, just signals exactly what's going on in the housing market right now and the fact that so many first-time home buyers simply cannot afford it no matter where they are in the country.
That's absolutely right. It comes back to affordability. And this is a generation of Americans, entering their mid-30s now. The core of the millennial generation is very numerous. There are several million extra people in their early 30s and late 20s right now. And they're just as determined as previous generations to get into homeownership, but they're running into the biggest affordability challenge in a generation maybe that we've ever seen, thanks to that 1-2 punch of prices and mortgage rates. So people are getting creative. They're thinking of other ways to get into homeownership. We have seen, some other kind of life milestones are delayed for the millennial generation, things like marriage and having kids. So that kind of creates this situation where there are folks, in their early 30s or late 20s who might think, okay, how about if, my parents go in on a house with me? How about if my friends and I go in on a house together? We've got a place to live. We know that the price, that our monthly rent isn't going to keep going up, like if we stay in the rental market. So it's kind of folks looking for ways to get into homeownership. And I'm definitely reassured that the way that they're doing it is not, what we did in 2005 and 2006 with ninja loans and no underwriting and, balloon payments. Mortgage underwriting is still rock solid and very strict, frankly, for home buyers. That's why people are looking at these methods of, just thinking, okay, who can I buy a house with if I can't just do it alone right now?
I don't know. Still sounds a bit risky to me, just in terms of owning a home with friends or other family members. But I don't know. Maybe I'm the outlier there. Jeff Tucker, great to have you. Thanks so much for joining us this afternoon.
An interesting finding out of Redfin's predictions for home sales in 2023 released today. Now, home prices will see their first year-over-year decline in a decade, and home sales will fall to their lowest level since 2011. We're here with more on the future of housing is Mark Norman, Associate Dean of the Schack Institute of Real Estate at NYU School of Professional Studies. Good to have you on. So I first want to get your take on these findings from Redfin. Are you seeing trends going in that same direction?
We are seeing trends go in that same direction. Thank you for having me, by the way. But at the same time, we have a supply problem with housing. So there's still so much housing that's out of reach for Americans that we'll see the price declines, but I think the income gains that we're seeing lately still aren't keeping up with the prices that we're seeing in the market, in most markets.
And as you mentioned that supply issue, then how much imbalance is there between the buyers and sellers' demand and selling right now?
Yeah, I mean, it's really interesting because there's been this sort of uptick, but we, for the last 20 years, have underbuilt the housing. I think the housing crisis actually exacerbated that. In 2008, right, we saw the sort of demand go down, but it never came back in terms of supply. And now that we're in this inflationary environment, I feel like we're in a place where the housing can't keep up with the demand. So even though we see this decline in prices, I don't know that we see more people that can actually afford houses. And that's really the issue right now.
Because there really was that fear coming out of the housing crisis that led to the underbuilding, really not sure what was going to happen with the housing market. But I want to ask you, in terms of policy-wise, is there something, whether it's zoning or other ways, that could help perhaps alleviate some of these stresses?
Yeah, I mean, I think there are a couple of things, and I think it's interesting because it's less on the federal level and more on the state and city level, and that's trying to increase that supply and also trying to sort of ease some of the restrictions on builders so that that housing can be built quicker. So that at our current capital markets conference, the mayor of New York announced, a number of different ways that they might work to speed housing. We're also seeing in places like California this switch to allow multifamily units in single family neighborhoods. And then we also see alternative lenders coming in to say, we'll actually, evaluate buyers in different ways than the traditional market might. So maybe not looking at a steady income over time, but creating a space so that those gig workers and contract workers that might have steady incomes, but not as legible as a standard worker might be able to have access to housing in ways that the banks aren't really underwriting.
And that could be a real game changer because we know how tough it is for first-time home buyers at the moment. And even when you look at mortgage rates, we're seeing that the average 30-year fix has roughly doubled from the start of the year. What are your expectations going into 2023 in terms of affordability and what we might see with mortgage rates?
Yeah, I mean, I think mortgage rates are going to stay high. And actually, when I say high, they're going to go back to probably what's a new normal, right? I think we really got used to a low interest rate environment over the last 12 years. But if we look at the last 30, we're actually coming into a place that's more in line with traditional mortgage rates. But I think we have to get used to that. It's going to take probably a number of years for prices and housing stock to adjust to that kind of mortgage environment. But the 6 to 7% interest rate isn't an anomaly unless you're just looking back at that last 10 years. I think one of the other things, though, is that we don't build starter homes in the way we used to. So homes got bigger, prices increased, and the market met it there. But that really put housing out of reach for a lot of first-time buyers, especially.
And Mark, I do want to ask you about the rental market, because obviously renters also being squeezed as there isn't enough supply for them to be able to get into houses. What are your expectations there? And any sort of policy things? We know that in parts of Asia and Europe, there are some regulations on rent growth that could help people. Anything that potentially could help here in the US?
Yeah, I mean, once again, it's so city by city in the sense of, right, California, New York have rent stabilization programs that might keep the sort of inflation in rents in check, but also might constrain supply. Other places you don't have those sort of limitations on, how rents can increase. But you also, in places like Texas, actually have that increasing supply that keep prices relatively stable, except of course hot markets like Austin and now Dallas. But it really is a matter of supply. And to the extent that we don't have the supply, I think we need the supports. We're also seeing some of those supports diminish, right? So the eviction moratoria or the pandemic programs that helped renters get through this period are going to be expiring. So I think we're going to see a little pain in the housing markets for a while, especially among the low and moderate income renters and borrowers for mortgages.
Tough times ahead indeed. A big thank you for joining us, Mark Norman, Associate Dean of the Schack Institute of Real Estate at NYU. Thank you for bringing your insights.
All right, we're going to do a little deep dive on the commercial real estate market now and breaking it down in three distinct categories: multifamily, industrial, and office. Three markets in one region really stand apart from the rest: Nashville, Tennessee, Raleigh, and Charlotte, North Carolina. You have this entire massive country, and yet these are the three in one particular very isolated region. All three cities are considered cadre MVPs, or the triple crown of real estate, if you will. Why? Well, let's talk about that with Ryan Williams. He's the Cadre co-founder and CEO who joins us now in studio. That was very interesting information to see why this small region, we have this whole country, most of which saw enormous growth in 20 and 21. What stands out about those three markets and that region?
Sure, and thank you for having me. There are really two key drivers. One is demand, second is affordability. Demand, job growth, number of people making trips, leisure, and affordability, the cost to live, the cost to visit, the cost to reside in those two markets. And so those are the two variables that made those three cities our Triple Crown.
And how do you quantify that?
Sure. We quantify a lot of it using third-party data. So census data, a lot of demographics data, how many millennials moved in, moved out. We also have some proprietary transaction data. We underwrite real estate around the country, and we get an insight into which properties are performing, which ones are not. So we know what pricing is in and around certain markets as well. And then we look at like mobility data, geospatial data, and aggregate everything. And we say, which of these markets around the country on a relative and an absolute basis do we feel are growing the most and are most affordable? That's the magic intersection.
Okay, so let's take the region out and those three cities out and just talk about the three sectors of commercial real estate which we had up to begin. Which has the best outlook in the economy that we're headed into?
Yeah, we are investors across an array of sectors, sure. But we do believe in focus, especially at this point in time when affordability is more challenging than it's ever been. More people are being priced out of buying homes given where rates are. Yeah. And so out of the multifamily, industrial, and office sectors, we like multifamily the most. It's one of the most resilient sectors because people always need somewhere to live. And at a time like this, people are renting more. And so what we're seeing is renewals at all-time highs around the country. And more and more people saying, you know what, I'm going to kick the can on buying a home. And what we're doing is we're buying more apartment buildings, multifamily buildings, letting people buy fractional stakes versus putting up money for a mortgage when mortgage rates have gone through the roof.
Now, I talked about those three cities in that region that stood out. What else stood out about the lists is there was no New York, there was no Los Angeles, no San Francisco, no Chicago, the biggest cities in the United States and the biggest metropolitan areas. Why so? Why are they absent from those lists?
Affordability. That's the name of the game. I mean, in New York City, for instance, where I've rented for a while, rents have been at an all-time high, despite the lack of demand and so many employers moving outside of the city. LA, Chicago, same dynamics. And so because these places are still relatively less affordable than some of the other markets and geographies, they're lower on our lists, and we think they have much more bearish prospects going forward.
An interesting piece in the Wall Street Journal today described commercial real estate market on the precipice, really. It described investors yanking money from several enormous funds. Are you bullish in spite of that about the commercial sector?
We are, multifamily, industrial in particular.
But not necessarily office.
Not necessarily certain types of office. We actually think there are suburban office assets and buildings that are interesting. Life sciences is a niche that we've liked historically. And we think there's opportunities to convert some office buildings into residential. But big city office, we still think many landlords haven't adapted to the realities of this new, I want to say post-COVID, but almost post-COVID world.
Yeah, how does remote work factor in and change the outlook for office?
Well, really what it does is it changes how people think about space. It used to be how much density, how many people can you fit into a given space? Now it's how few people can you fit to give people that space that they need to feel safe and feel comfortable and the like. And so we're now focused on office buildings selectively where there are large floor plates, there's open space, there's good amenities. But for the most part, multifamily is what we focus on. And you brought up the redemptions point from those two big funds. We've always been focused on giving liquidity to investors. That was why I started the company. And so I think you're now seeing in times like this when individuals need flexibility, platforms that can offer that, such as ours, are the ones that will ultimately be able to serve the needs of individuals.
Yeah, you mentioned amenities. Never before have they been more important in terms of the things you have to provide to get people to offices. I want to close because you study such a broad spectrum, the residential sector. What is the impact you're seeing from increased Fed rates, increased mortgage rates? Basically, I'm going to do this. Some people think it's going to crash, a 20% drop. Others think we're just going to level out. We're still up 10% year over year in terms of median home prices. What do you see around the corner?
Look, I don't think this is an 08, 09. I don't think leverage is as out of control as it was at that time, and you'll see a huge crater. I do think there will be a correction. We've seen residential assets correct 10, 15, 20% down from where they were just months ago. And I think you'll continue to see a minimal decrease in the single family space over the next 3 to 6 months. And then I think you'll see
You're
a slight recovery.
low single digits over
Low
the
single
next...
digits over the next 3 to 6 months, because I actually believe that banks were a lot more responsible this go around, and a lot of banks are pulling back. And so you're not seeing the same subprime issues you saw. And there still will be micro opportunities. That's the beauty of real estate. That's what we tell our clients all the time is even amidst these challenging macro times, there's always micro opportunities. And this is where a lot of wealth can be created if you pick the right sectors.
Got to be very, very selective.
Very
he
selective.
is Ryan Williams, the co-founder and CEO of Cadre. Good to see you, man.
Thank you.
Thanks for
Appreciate
coming
having
in
me.
studio.
Thank you.
Appreciate that.